Warren Buffett said something that stopped me completely cold. He admitted he pays a lower tax rate than his secretary. Not because he cheats, not because he hides money offshore, because he understands something quietly written into the tax code itself. You work hard, you earn money. The government takes 40%. Before you touch it, before you spend it, it is gone. And somewhere across town, a billionaire's net worth grew by millions. He paid almost nothing on that growth. Legally, completely, openly. By the end of this, you will understand exactly how. Hit subscribe if you want to keep running the real math. The rich do not play by different rules than you. They play by the same rules. They just actually read them. There are two tracks inside the American tax system right now. Track 1 is for workers, people who trade time for money. Track 2 is for owners, people who let assets do that. Workers pay income tax, the highest rate the code allows. Owners structure everything to avoid income tax almost entirely every year. That is not a conspiracy theory. It is basic tax architecture. The loophole is not buried in some offshore Cayman Island account. It is sitting on page 1 of the tax code itself. The rule is this: you only owe tax on realized gains. Realized means you sold something and received actual cash in return. If you never sell, you never trigger the tax event. Your stock goes from $1 million to $50 million. The government sees zero of that because you have sold nothing. Elon Musk's paper wealth grew by tens of billions in years. His reported taxable income was, in some years, remarkably close to zero. Jeff Bezos held Amazon shares worth more than most countries' entire economies. The tax bill on that growth was essentially nothing, unrealized, untouched. This is not illegal. It is not sneaky. It is intentional. The code was written this way, and most people never learn it. But here is where it gets genuinely, almost uncomfortably clever. Stay with me. Having billions in untaxed assets creates an interesting problem for the wealthy. They need actual cash to live, to spend, to operate daily. Selling assets would trigger the tax event they have spent years avoiding. So they do something most people never consider as a real option. They walk into a bank and they borrow against those assets instead. Banks will happily lend against stocks, real estate, business equity, almost anything. And here is the critical piece that changes everything. Loans are not income. The IRS does not tax borrowed money because it must be repaid. So the billionaire borrows $50 million, spends it, lives on it. Zero tax owed on that $50 million. None whatsoever. The assets keep growing in the background, still completely untouched by taxes. They borrow again the following year against the no larger asset base. This strategy has a name, and the name is almost too honest. It is called borrow, die, and it is entirely legal. By appreciating assets, borrow cash against them, and never sell anything. But wait! What happens when the billionaire eventually dies with unpaid loans? This is the part that genuinely made me sit completely still. When someone dies holding appreciated assets, something called a stepped-up basis applies. The heirs inherit those assets, valued at TODAY's market price, not original purchase. Every decade of growth, every unrealized gain, simply resets to zero taxable basis. The 50-year-old investment that grew from $20,000 to $20 million. The heirs inherited as if it was a sow. WAYS, worth $20 million. The accumulated tax liability, potentially hundreds of millions of dollars, is simply erased. The loophole does not just reduce the tax bill during their lifetime. It eliminates the entire thing permanently, across generations, compounding forward without interruption. This is why inherited wealth moves differently than earned wealth ever could. Now, you cannot borrow $1 billion against Tesla shares today. Understood. But the same underlying logic scales down to where you actually are. Every dollar you invest instead of spend delays your tax event forward. A dollar growing inside a Roth IRA grows and exits completely tax-free. A 401k defers the tax hit until you are older, earning less. Real estate depreciation lets you offset actual income with a paper accounting loss. Long-term capital gains tax rates are roughly half of ordinary income tax rates. The gap between selling quickly and holding patiently is enormous over real time. The billionaire version is extreme. Your version is just the same principle, scaled. The mindset shift is worth more than the specific strategy that follows it. Now, here's the part that genuinely frustrated me when I first understood. None of this is taught in school, not one single class. It is not in anyone's interest to explain the ownership track to workers, Workers are the engine, and engines are not meant to know they are engines. Politicians debate closing these loopholes publicly, loudly, with great television-worthy emotion. Then they go home to portfolios structured around the exact same strategies. The loophole survives because the people who could close it actively use it. That is not cynicism. That is documented, observable, verifiable, political behavior. The tax code rewards a specific behavior and punishes the absence of it. That behavior is ownership, holding assets, not trading time, not earning wages. 3 steps. That is the entire billionaire formula when you reduce it down. Own assets. Borrow against them when you need cash. Never sell them. The tax code does not punish the rich for being rich. It rewards people who understand that owning beats earning at every level. Now you understand what they understand, and knowing changes everything going forward. Drop a like if this genuinely shifted something in the way you think. Comment below and tell me honestly, did any school ever teach you this? Share this with one person who needs to hear exactly what you just heard. Next video, I show you how the ultra-wealthy protect that money afterward.